Hey everybody, we'll give everyone a few more minutes here and then we'll go ahead and get started. Well, hello everyone, and welcome to today's wellness webinar, Retirement Investing Made Simple. We're excited to have this discussion today that's designed to give you clarity on how to approach investing for retirement, regardless of where you're starting from. Whether you're brand new to investing, already saving in your 401k, or starting to think more seriously about retirement, our goal today is to help simplify the process and help you feel more confident about the strategy behind it. My name is Nash Holm, and joining me today is my colleague Kenji Noguchi. Together, he and I have worked with hundreds of plan participants, just like you all, to help them navigate their workplace plans and their financial lives. We're passionate about helping people get organized financially, and that includes not only saving, but investing with intention. Here's what we'll cover in today's discussion. First, we will walk through the core building blocks of a strong investment plan. This section will give you a foundational understanding of how investment strategies are built and why things like time horizon, diversification, and risk tolerance really matter. Then we will walk through how to invest more tax efficiently. We'll discuss how different account types are taxed, how to keep more of what you earn, and why tax planning is such an important part of retirement strategy. And then lastly, we'll wrap things up with a look at what we call that final stretch, the last 5 to 10 years before retirement, and what steps can help you move from just saving to actually strategizing for your retirement years. Now let's start with the foundation of investing, what we refer to as the building blocks of a strong investment plan. This section is important because it shifts the mindset away from just choosing funds or chasing returns, and instead focuses in on having a framework. Now, good investing is rooted in process, not predictions. It's about understanding your own goals and building a strategy that supports those goals over time. Whether you're saving in a 401k, an IRA, or a brokerage account, the framework we're going to walk through this today applies to all of it. Once you understand these building blocks, you'll be in a much better position to make confident, consistent investment decisions. Now, the first and most important step in building a plan is to clearly define your investment goals. Your investment goals will vary based on your stage of life. For some people, the primary goal is long-term growth for retirement, maybe 20 or 30 years from now. For others, it might be generating income in retirement or preserving the money they've already saved. It's also common to have multiple goals at once. For example, saving for retirement and for a child's education simultaneously. These goals will determine how your money should be invested, and they'll help define things like how much risk is appropriate, what your timeline looks like, and how to prioritize one account over another. When your goals are clearly defined, the rest of the strategy becomes easier to build. Now, when I'm working with it, folks, the first thing I bring up is goals. You know, I sound like a broken record sometimes. Kenji can attest to that, but that's because it's the most important part in building an investment plan. Kenji, what are your thoughts on goal-based investing?
I think you hit the nail on the head there, Nash, right? If you've sat down and talked with us, we preach it like it's gospel, right? We need to be strategic in our approaches to managing our own investments. And really when we prioritize achieving specific goals versus, just, hey, how's my performance doing? Am I outperforming the market benchmark? I really think as humans, we gain that confidence in what we're doing and really our why. So I think the only message I'll just add on here is we need and we deserve a personalized investment strategy. So as we move forward here, I think on this next slide, it breaks it down very cleanly. And these are going to be the core steps to actually creating that investment strategy. Ultimately here, folks, right, once your goals are defined, goal-based investing, we want you to assess your risk tolerance. So what do we mean by that? Well, how much fluctuation do you think you can reasonably handle in your account value without abandoning your long-term plan or whatever your goal is, right? Risk tolerance, it's completely personal, and it's going to depend on your personality, your financial situation, and maybe even where you're at in life. But I think as we go down the steps in this list, you'll see how they all connect together, where our third point is time horizon, right? The length of time you need to use the money that you're investing. So longer your time horizon, generally, right, the more risk you'll be able to take on in the pursuit of growth. Asset allocation. What's a mix of the investments that you hold? How much is it in stocks, equities, bonds, debts, or even cash or money markets? But very lastly here, diversity. What is that? Well, it's that risk management of where are your investments actually across different type of asset classes. So, are you exposed to only one area of the market, or do you have total diversity? So again, these are just going to be those starting points. What are the actual steps? Where do we start goal-based investing here, folks? So let's peel some of those layers back and dive into each of these steps further. And what we're seeing here is the classic saying, I love to say this, no risk, no reward. It's a fundamental concept to every investment decision that we're going to have. And I think really what Nash and I are getting at here is that the higher risk an investor is willing to take, the higher the potential return that they could actually expect on their investment. I think all of us subconsciously do this to a degree, right? What's my ROI, or am I going to make money if I actually invest in this? Well, it's the same thing when we apply that across, our investment accounts or retirement accounts. The theory here is that investments like stocks, they have potential for higher long-term growth, but they're also going to come with a little bit more volatility. So what's the flip side of that? Well, maybe our bonds, our cash equivalents are going to be more stable, but as they're lower risk, we're going to have lower potential on those returns. So, ultimately here, choosing your risk, it's going to depend on your goals. What's your time horizon, and how comfortable are you actually with market swings? And I think this is so relevant in today's time because the market has been going up and down. We like to call it a bunny market. But when we home it back in and think about retirement, a younger investor, call it 20, 30 years into retirement, they certainly should be or more able to take on that risk versus someone who's planning for retirement in just 5 or 7 years. So it's just an important note that we have to understand this trade-off between risk and return, and what is your investment choices going to be that are most appropriate for your situation. So just to take some homage out of Nash here, I'll sound like a broken record once again, but we say this all the time. What's your timeline? What's the due date? How long do you plan to hold an investment before needing to use that money? That's your time horizon. And specifically for retirement investing, again, if your horizon's 10, 20, or 30 years, you typically might be able to take that more aggressive or moderately aggressive investment strategy because you can handle that volatility on the chin. You're capturing tax advantages with that deferment of taxes or even tax-free growth in a retirement account. So why wouldn't you maybe have a little bit of exposure into some of those highly aggressive growth vehicles, right? On the flip side, yet again, well, hey, if we're getting close to retirement, or maybe it's something else in life, right? We want to purchase a new home, or we want to move, get a new car because we just had a newborn baby. You may want more conservative allocation here. The bottom line is, it's one of the most important drivers of how your portfolio should be structured. I think we say it all the first. What's your goal and what's your timeline? So as we dive further here and we take a look at asset allocation, and again, this is one of those points where we have to really decide, how do we divide our holdings? Is it just all stock? Are we all bonds? Are we all cash? Or do we have a good balance in between them? And I think really here, we have to just think, okay, well, if we have a higher concentration in stock or equities, our growth potential over the long term, it's gonna be better, tends to be that case, but it's also gonna fluctuate. So are you gonna be able to handle that in your day-to-day life? Is this causing you stress? Is it causing you to second guess what your strategy is, or even what your goal might be in the meantime? But again, we take all these things that are unique to our own individual situation, our age, time horizon, goals, risk tolerance, all of those different things are going to factor into your asset allocation. And it's almost a sliding scale, we like to say, right? Because these things don't have to be set in stone, but it's just something that we have to understand and say, well, where are we at in our lives and what type of allocation is going to work best for me? And I think I'll add a little flavor here, maybe to give just everyone a little bit of a good example of like really how this might differ from each individual. I think Nash and I could be a good example. I have a 2-year-old daughter where I have a greater need for liquidity, but also as a new dad, I think I have a newfound sense in my risk tolerance. I don't want to take as much risk with my accounts as I once did before my daughter was born. I think there's just a sense of security or a peace of mind where, to me, it makes logical or life sense to have a greater allocation in cash or bonds. Nash, I don't want to speak for you there, but certainly, I know you don't have children, but maybe that's something different for you and your family and household. Maybe, again, you might be more aggressive as you're gearing for retirement, but maybe even planning for children too. All of this comes together, folks, right? And as we see here, okay, so we know our goal, we know our timeline, how our risk tolerance might evolve where we're at in life. Well, then very lastly, we have to talk about diversification, right? And I think we've all heard this one. Don't put all of your eggs in one basket. So we're really just trying to strategize of where should we spread our investments, maybe not only across the type of vehicles, equities, bonds, or cash, but maybe the actual asset classes or sectors. How are we utilizing those things to help reduce our overall risk in the portfolio? Again, right, if the purpose here with diversity is if we have a downturn in the market or maybe in a specific asset class, if we have diversity, we're not going to feel the greatest loss. It's going to reduce that likelihood a single event or just a single class blows up our entire portfolio. So we have to keep this in mind, right? It's one of the simplest, most effective risk management tools available to investors. And the good news is, as a retirement or participant of a retirement plan, you're always going to have diversity within your fund lineup. So if you're, again, curious what that looks like, come have that conversation with us too.
Thank you, Kenji. Yeah, I think that makes a lot of sense. We need to start from square one. You think about your goals, and that drives everything. I really like the example you gave, just relating it back to the two of us. Even though we're similar in age, our goals are much different. That's why thinking about your goals first is so important. What you're saving for will help you dictate your time horizon, asset allocation, and your risk tolerance as well. That brings us to the end of the first section, but now let's take building blocks of a strong investment plan one step further. In this next section, we're going to talk about how taxes affect your investments, why the final years before retirement are the most important time to coordinate all of this into a cohesive strategy. Most people think investing is just about growing your money, and while growth is important, the real goal is to keep more of what you earn. What we often see is that people with similar investments can have very different outcomes in retirement, not because of performance, but because of how their investments were taxed. That's why we say it's not just what you make, it's what you keep. And to keep more, you need to understand how your investment accounts are taxed. Let's walk through how some of those different types of accounts are taxed. On the left-hand side of your screen, you'll see qualified accounts. These are things like your 401k, traditional IRA, or Roth IRA. And these are all tax advantaged. That means that they grow either tax deferred or tax free, depending on the account. Pre-tax accounts grow tax deferred. You don't pay taxes on contributions or growth while the money stays in the account, but when you withdraw money in retirement, it's taxed as ordinary income. On the other hand, with Roth accounts, you pay taxes upfront on the contributions. Your contributions and any earnings grow tax free. And when you take money out in retirement, you won't owe any taxes on your distributions. Now on the right-hand side of the screen, we have non-qualified accounts. These are things like brokerage accounts, and they don't have tax advantages, but they do have more flexibility when it comes to how you can access the money. They're less restrictive in terms of distribution rules. Now, non-qualified accounts, in non-qualified accounts, you pay taxes each year on your dividends, interest, and any gains when you sell investments. Understanding what types of accounts you have and how they're taxed can help you decide not only how to invest, but where to invest. But what Kenji and I are trying to get at here is that the tax code doesn't have to be your enemy. It can be a tool if you know how to use it wisely. To understand why, let's talk more specifically about capital gains, which come into play in non-qualified taxable accounts like a brokerage account. If you sell an investment for more than you paid for it, that's called a capital gain, and it's taxable. But there's a distinction here that matters. Short-term capital gains are gains on investments held for 1 year or less. These are taxed as ordinary income, often at a higher rate. Long-term capital gains apply to investments held for more than a year, and they're taxed at a lower, more favorable rate. The simple act of holding an investment a bit longer past that 1 year mark can have a meaningful impact on your after-tax return. So part of investing smartly isn't just choosing the right asset, but managing when you sell it and how that fits with your tax picture. Kenji, what are some of the strategies people can take advantage of to balance tax efficiency and liquidity across these different types of accounts?
There's quite a few. I think that's a good segue, Nash, because, I think it's relevant for us to talk about capital gains and qualified, non-qualified accounts, because we understand, right? Not everyone might have access to a retirement plan. Some folks might have never even thought about an outside IRA, right? It just depends where they do. Give you an example, maybe a small business account where they've just always put money back into the business versus building a retirement plan for themselves. So they've always just saved in a non-qualified account or a savings account, right? And I think this slide is really going to illustrate, it's a hard art to balance that tax efficiency of what you have with maybe where your life is at. So if we're looking at this slide here, I think our message is still very kind of general in that, hey, we want you to first understand, do you have accessibility to these type of accounts? And if you do, let's utilize them. I think that's the very first step. If you have tax advantage accounts, a 401k, a 403b, IRAs outside, or even if you're looking at maybe the medical side, health savings accounts, flexible spending accounts, I think these are valuable accounts and tools that you have to utilize. So I think that's our starting point. If you do these, well, you're capturing tax advantage off the bat. Now let's structure them in a way by looking at what's our timeline. Are we investing for the long term? Are we going to use specific tax efficient funds, or are we going to look at individual stock holdings or debt instruments, right? The allocation. But all of these different things matter. Really, I think, again, our message is if you have the tax advantage accounts available to you, let's explore them, let's break them down, and let's make sure that we're utilizing them. Any accounts that are outside of it, yeah, we have to be conscious. What's the timing of our sales? Again, what type of funds are we using? But then we also have to think about maybe these other life scenarios that could come into play where, it lists here primary residence exclusion for capital gains, but there are other ways that we can maximize our taxes in an efficient manner, whether that's charitable giving or charitable gifting, or maybe it's Roth conversions, or heck, even tax loss harvesting to try to net out those gains and actual tax liabilities. So again, what's important here is the balance of how we should consider our liquidity needs and that risk tolerance. And sometimes it might not always be perfect, but we want to aim to be tax efficient, but certainly be smart and aware of how our money is aligning with our overall plan or whatever goal we've set. So we keep on the heels of this, right? Tax strategy, it certainly matters. And, I think up to retirement specifically, it certainly does matter of, where do we pick and choose to place our assets, but it becomes even more pertinent once we actually reach retirement, right? Because at this point, when we're in retirement, it's not about saving or growing anymore. It's how are we withdrawing our money that's going to make sure we're minimizing those taxes, but keeping our portfolio alive for the long term. So obviously, I think the hardest thing for retirees is how do I actually coordinate which accounts do I draw from and in what order? What makes sense, right? And I think a perfect example, I was talking with a participant earlier this year where older individual, she was married, same thing, large tax deferred balance where they didn't need income just due to other side businesses they had. So they didn't take any money from their tax deferred accounts, and those just continued to balloon. They delayed Social Security because they didn't need the money, because they saw the benefit of, hey, I can have a higher payout if I delay that. And it makes sense, right? It's a tax deferred. I should just never worry about that and let that grow forever. Well, in her case, it wasn't necessarily the same because she wasn't thinking about RMDs coming at age, when Social Security started to come out. And unfortunately, right, husband passes away, where a few years later, she might have to even change her tax filing status. So again, tax strategy, it's so important here. And it's something that we have to keep our head on the swivel. Nash, is there anything that maybe you'd like to add here too?
You know, Kenji, I think you hit the nail on the head. I think the important takeaway here is that tax planning in retirement isn't something you figure out year by year. It's something you really need to plan ahead for. And when you do it well, it can reduce taxes, not just in 1 year, but across your entire retirement. Now, up until now, most of what we've talked about applies broadly: saving, investing, tax efficiency. But at a certain point, you move into a new phase. We call it the shift from saving to strategizing. And for most people, that starts in the final 5 to 10 years before retirement. During this period, the margin for error does become smaller, and the value of making smart decisions becomes much larger. But the good news is that the opportunity is greater than it's ever been. This is when it's time to coordinate everything: your investment mix, your account types, your income plan, and of course, your tax situation. And the good news is you don't have to do it all at once. You just need a roadmap for what to focus on. Here's what that roadmap looks like. This slide highlights 5 key reasons why it's so important to be intentional in that final stretch before you retire. First, the 5 years before retirement are often the most financially critical. During this window, you're usually at your peak earnings. Your portfolio is the largest it's ever been because of all that compounding over the years. And the decisions you make now can set the tone for the rest of your retirement. Second, mistakes made during this time can have a lasting impact, not just on your account balance, but on your retirement lifestyle, your ability to generate income, and how long your money lasts. That's why the years leading up to retirement aren't just about avoiding mistakes. They're about getting organized and preparing with a purpose, which brings us to the next point, that at this stage, it's not enough just to keep saving, and you need a clear plan. That means knowing how your investments are allocated, how they're taxed, and how you'll draw income when the time comes. Fourth, you should be asking detailed questions such as, am I investing in a tax efficient way? What will my Social Security strategy look like? And do I have a plan in place for healthcare expenses, especially Medicare? And lastly here, this is oftentimes the most important point that we try to get across, is that this is often the time when guidance from a professional can make the biggest difference. Having somebody in your corner to help you coordinate investments, taxes, and income can help you make the most of everything you've built and avoid costly missteps along the way. This is where strategy really replaces the guesswork. And the sooner you begin thinking about these pieces, the more flexibility you'll have going forward. Kenji, anything you'd like to add there, or any thoughts on that?
I liked everything you said, Nash. I really do. And, I think my only tip or advice to everyone here listening is, not only even 5 years out from retirement should we start, really strategizing and creating clear roadmaps, but maybe even 7 years out, right? Let's give ourselves a little bit of wiggle room in case we need to make drastic changes the first 2 years, where the final 5 years right until retirement, we are really confident in what we're about to do and how it's going to play out. So let's just keep that in mind, right? Speak to an expert, reach out for help if you're just unsure, and let's start creating and tailoring that plan for you. So to wrap up today's session, we always like to give you folks clear, practical action steps that you can take. And, whether you're near retirement, still building towards it, or even somewhere in between, take these steps and everything that we've covered today to help you out in a relevant way. So step 1 is always, what is your financial inventory? What accounts do you have? Confirm, are they taxable or are they non-qualified accounts? What's step 2? Well, okay, it's our asset allocations. You guessed it, right? So we have our inventory. How are we investing within them? What's the tax treatment on them? And what type of returns are we looking for? What type of risk do we want to take based off of our timeline and that time horizon that we have, okay? So we have to understand that timeline. Again, for the sake of saying it a third time, right? What's your goal and what's your timeline? We have to understand those things. And if they change, that's okay, but let's make sure then our asset allocations align with that. And let's say you're at the home stretch here, and now we need to optimize our withdrawal distribution strategy. Okay, well, let's play with that sequence. If we've done the first 3 steps, it becomes almost clear for us to say, okay, maybe we should start tapping into our pre-tax bucket. If I've been deferring that, let's think of that RMD balloon kind of case study we talked about. Maybe it's, hey, I should be all in on, these tax-free buckets because I'm in the lower tax bracket as I sit right now. Bottom line is we have to think about our withdrawal strategy, and then are we taking advantage of some other tax advantage accounts? Again, those health savings accounts, flexible spending accounts. Maybe if your goal is beyond retirement for your children, 529 accounts. Bottom line is here, folks, we need to take action. Let's not have paralysis by analysis. These things certainly can be complex and difficult to understand and grasp of where I want to go or where am I at today. But you have people on your side. You have experts to talk to. So again, whether that's us and our team, whether that's your advisor back home, or heck, even if it's just your spouse or partner, to have someone on your side is going to be a big win for you. So again, don't be shy. Reach out if you need that help, and let's start strategizing. I think the best thing I always say is, well, when's the best time to start? Well, at least 7 years out. And if you're past that, the best time to start was probably yesterday. Second best time today. So let's take action, folks.
Well said, Kenji. I completely agree. Those are important steps everybody on the call today can take to ensure you're putting the right foot forward when it comes to your investment plan. Now, remember that you don't have to go about this alone. We've said it a couple of times already, but guidance from an expert can provide you with more confidence and clarity about your plan. Next month, our topic revolves around just that. Smart tips for finding a financial advisor you can trust. We highly encourage you to sign up and join us for what is sure to be a thoughtful discussion. And lastly, if you're looking for some of that expert guidance we've been talking about, or simply have questions about how today's discussion fits specifically for your own situation, schedule a meeting with a member of our team. We're available to meet with you one-on-one to help answer any questions you might have. That's all for our webinar today. Thank you all so much for joining, and we hope to see you again next month. Have a great day.